Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 299 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, we are blessed to welcome the one and only Nick Whitaker to the podcast. He is Jessup Wealth Management Director of Research and Trading. Nick, welcome.
Always good to be here. It's a good night last night. The Knicks pulled out another surprise win.
All right, so what was your thoughts on the Knicks sweeping the first two games at home versus the Celtics and the Pacers and the Pacers sweeping Cleveland? What's your thoughts on this?
I am flabbergasted, to say the least.
We got barn burners happening right now in the NBA, and then you got the Pacers social media trolling Cleveland.
Yeah. Oh, yeah. You show me that. Yeah, that's it's a lot of fun. A lot of fun.
NBA's fun right now.
Yeah.
It is. And I know everyone kind of jokes that, well, the defense starts in the playoffs. And these guys are putting their back into it. These are some low-scoring games.
Yeah, they are really low-scoring games, a lot of them. Yeah, it's been fun. I mean, I think the first round of, or the first game of the second round, all road teams won.
Isn't that crazy?
Yeah.
I mean, the stats
wild.
behind that. That's
I can't
crazy.
imagine. If you would have put a parlay on that, I can't imagine.
That was not on my bingo card, right?
No.
Not on my bingo card. Before we do pricing, I want to just remind listeners before we get into the show, if you've been enjoying the Independent Advisors Podcast for a while now and you want to take the next step in your financial journey, I'd encourage you to head to our website. That is jessupwealthmanagement.com. And I, Matt Jessup, I'm offering 15-minute initial calls where you can discuss your financial goals and see if JWM would be a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click on Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help me guide the conversation and ensure that our time is used efficiently. And again, if you're ready to learn more, visit jessupwealthmanagement.com and book your call today. One thing that's kind of interesting as we get into the podcast, Nick, I had a call from a potential client yesterday, and they conveyed a situation that I think is more widespread right now. And it is this. This individual sold out of the market on April 7th and calls me up and says, hey, I was referred to you by XYZ. And there was more background, but then pretty much was like, what do I do now? And we obviously had that conversation. But I think that there are a lot of individuals in late March and early April, given the news stream, the concerns, and the headlines, that sold for whatever reason that they have justified. And then off that low, you got the market recovering low double digits. It's up another 1% pre-market today on May 8th. And the concern is now, what do they do?
Yeah.
And so that's definitely, if you're in that type of circumstance, especially, feel free to reach out to me. I'm happy to have that initial conversation with you.
Yeah, give us a call. In my experience, somewhat limited as it is in the markets, that's more common than you think.
Yep.
It happens. There's so much psychology around the markets. With individuals and their money, and it's understandable, and that's why we say work with your financial planner when you're getting nervous, and really working to make sure
have a
your
long-term
plan and your risk levels.
Yes.
It's very important. So
I got a hot take about the markets over the past roughly 6 weeks.
I love a hot take. I'm always here for a hot take.
Jenna, we're coming with the hot takes just right out of the gate. Right out of the gate. I can just see the listener comments on this one. So my hot take is, has there been money that's come back into the market? And I'm talking about the money that sold at the end of March, beginning of April. Has some of that money come back in? Yes. I could make an argument that a lot of it has not. That the move that you've seen, let's just use April 7th as my example. The move that we've seen since April 7th, I would argue, is a seller strike. And the reason I'm saying it from this angle is I saw this piece that had to do with like volumes, like block trades, like big institutions. And that really hasn't recovered since the selling pressure in February and March. So that's telling me there's still a lot of cash on the sidelines. You got a lot of the institutions who are still telling their clients. I mean, I saw a couple big Wall Street firms that are kind of doubling down on their really bearish calls at the end of March and beginning of April. There's a lot of cash out there. And I just think that if we avoid recession, which will be one of my talks today, if we do, there's going to be a lot of people buying back at higher prices. The only way these people make out is we have to go into a recession.
Big money too.
Big money.
Big money buying back. Yeah, it's interesting you say that. So for listeners, a seller's strike, what just in case you...
Please.
Yeah. Essentially what that means is volumes are a little lower, and a seller's strike meaning that the market is moving higher because more people want to buy basically than sell. And so the bid is getting driven higher. So the market moves higher at a quicker rate because there's less volume, essentially, to kind of the supply and demand it's a little shrunk on the supply side.
Yeah, I think that's well said. And I think the reason that I'm highlighting this is I think the average investor is thinking, oh, it bounced back, all this money's come back in. And I would make an argument based upon the way that I'm seeing it, that's not the case.
Yeah.
Some of this is my opinion, my experience. I'm seeing data sets like the block trades.
I've seen similar things.
All right.
I've seen things, multiple pieces discussing that the rebound, the bounce, whatever you want to call it, bear market rally.
Call it what you will. It could be a multitude of things.
Right. Was driven primarily by U.S. retail traders, and that the positioning of big institutions has actually stayed relatively similar to the lows that we saw, which basically means they were using the recent strength in the market to raise cash.
Wouldn't it be so interesting as the year goes on, not to say it's going to play out this way, this is part of the hot take, that the retail money was dead on, bought that dip, and the institutions, as the year goes on, are forced to buy in at higher prices? Wouldn't that wouldn't be on your bingo card for...
Yeah, it has happened some in the past couple of years where the U.S. retail flows have been...
more accurate in hindsight.
Yeah.
Everything in our world's hindsight, right?
Yeah, of course.
Nick, you want to go over pricing before we go into big headlines and current events?
Yes, absolutely. So as always, this pricing is from Y charts as of yesterday's close. Yesterday was 5.7. The S&P 500 was up 1.1% month to date and down 4.3% year to date. The Dow Jones Industrial Average was up 1.1% month to date and down 3.4% year to date. The NASDAQ Composite was up 1.7% month to date and down 8.1% year to date. The iShares Russell 2000 ETF, think small caps, was up 1.3% month to date and down 10.7% year to date. The Vanguard FTSE All World ex-US Index Fund was up 1.4% month to date and up 10.1% year to date. The 3-month Treasury rate is sitting at 4.34. The 2-year Treasury rate is sitting at 3.78, and the 10-year is sitting at 4.26.
A couple observations there. You know, right now, I think a lot of investors are still thinking about the market from a performance basis based upon the most recent high at the beginning of February.
Yeah.
So when you sit there and you say, hey, the S&P's down 4.3% year to date, that's very true, but most investors are thinking about the S&P still being off 10% from the high water mark.
Yeah.
That's the first observation. Second observation, this will play into our big headlines and current events, is the 2-year Treasury rate. There's been a lot of talk with the 2-year Treasury rate at 3.78, when you quoted that here a second ago, and the Fed funds rate being in the low 4s, that there's a lot of, say, pressure or feeling that the Fed should be lowering rates to be more in line with the 2-year. So, Nick, tell us what the Fed did yesterday.
Yeah, yesterday the Fed came out and kept rates the same, unchanged. And in a nutshell, they said we're not going to be rushed, going to be data dependent, as they always say, and as they typically always are, and that their outlook really depends on the White House and some of the news that's going to come out of the White House here over the next month, let's call it.
The only thing I've seen over the past couple of days that I don't think is getting enough headlines is the Fed is once again starting to do some very quiet QE, quantitative easing. And what that is for our newer listeners is they're literally printing money and they're buying bonds. They're supporting, and this was in regards to 10-year maturity U.S. Treasuries. So I just think it's interesting. I don't think it's getting enough headlines, but the Fed is out there again doing some quantitative easing. They are printing money and buying bonds.
You think they're doing that because of some of the volatility that we've seen in the bond market and just to also just kind of like stack up their balance sheet a bit?
Yeah, I just think there's a lack of appetite for long-dated treasuries, and they're having to support that right now. Interesting, right?
Yeah.
The other big headline is trade, but this one specifically in regards, I'll start with one, you can do another. I'll start with China. So China has come out and officially announced the beginning of trade negotiations. This quote is from May 6th, so from 2 days ago, Nick. Quote, Ministry of Commerce, China has carefully evaluated the information provided by the United States. After fully considering global expectations, China's interest, and the appeals of U.S. industry and consumers, China has decided to agree to engage with the United States. On May 8th, which is today, Treasury Secretary of the U.S., Bessent, will travel to Switzerland. While in the country, he's planning to meet with the lead representative on economic matters for the People's Republic of China. So that's definitely a positive, I would argue. What other trade news did you hear today, Nick?
Yeah, so this morning, a trade deal will be announced by President Trump at 10 a.m. Eastern Time.
About 40 minutes from now.
Yeah, about 40 minutes from when
we're recording right now.
This podcast.
Yep.
And that follows on news yesterday that the Trump administration will revoke the Biden administration's AI diffusion rule meant to curtail AI chip exports.
You want to talk about getting the semis going, baby.
Yeah. So
it's like lighting a match with a gas can next to it.
Yeah. So, yeah. So I imagine there'll be hopefully some good news at 10 o'clock. And this can just kind of start those news headlines where we start kind of getting the ball rolling downhill in a good way, so to speak, with trade negotiations. I still and this is a personal opinion, I still think we're in for a couple of negative headlines.
Sure.
As it pertains to tariffs, for a handful of reasons that I can actually go in a little later on the podcast.
I'll even go out there and say, just given the recent move over the past 4 or 5 weeks, it would be natural to see a little bit of consolidation in the market. And so you might see some panic buying in the short term for those that are sitting all in cash. But in my opinion, anything can happen. I just don't think it's going to go straight back up to its February highs. Yeah. It'll be rocky along the way.
Yeah.
Right?
Yeah.
Let's transition to tweets, articles, and research from this week. The first thing is I got to highlight companies in their stock buyback announcements. Nick, I saw this piece from Bar Chart, and this was just from 2 days ago. And Jenna will put up this chart for our YouTube viewers who are watching by video. Otherwise, for our traditional podcast listeners, our show notes in these charts that we reference can be found in all of our social media sites. Jenna uploads those so you can reference along with us if you wish. And Nick, this one, the underlying source is Berlini Associates. Hope I said that correct. I've quoted them off and on throughout the years. And it shows U.S. companies buying back stock at a record pace. And what it does is it goes back roughly a decade and shows through May 2nd the aggregate dollar amount of U.S. companies and what they've announced in buying back their own company stock. And we're on pace right now to have a record-breaking year, okay? Now, why is this notable in my opinion? we go back to the metrics of supply and demand. And if these companies are making lots of cash and they want to return money to shareholders, they got a couple tools in their toolbox. One of those tools is they retire stock. They go out in the open market, buy their stock back, and retire those shares. So when you're doing calculations on earnings per share, if you have less shares outstanding, you're raising artificially the value of the shares that remain, right? And so this is a popular way to, in essence, provide a tailwind for stock.
Yeah, you're
right?
increasing the value of the stock.
Of that remains in the market. Yeah. So this is very good. So it got me thinking. When I saw this chart, it was like a God moment. I had a client reach out to me, and every once in a while, this client has been a long-term shareholder of a specific name. This name is Apple, and this is not a recommendation for or against the stock.
This chart is wild.
But Jenna will put up this chart for our YouTube viewers. This will also be in our show notes. And this is a chart of shares outstanding for the Apple company, the Apple stock. And the chart goes back to the mid-'80s, Nick. And what you're going to notice is up until around 2012 to ish is when the company stopped issuing stock to raise money and they started buying stock back. Well, it's very notable in the late 2000s what Apple invented. They invented the iPhone. And that really changed the trajectory of their balance sheet and cash flow. Where I'm going with this is the number of outstanding shares of Apple peaked at that point around 25 to 26 billion shares outstanding. They've been consistently buying back shares since that time period, and the share outstanding is now down below 15 billion. And just this past week, they announced another 100 billion stock repurchase program. And so I'm just using this as an example, a very easy illustrative example on how consistent stock repurchases can really return some value to shareholders. So all of a sudden, when you go from 26 billion or so shares outstanding to 15 billion, all things the same, the people who are holding those shares, they're worth more.
They're worth more, yeah.
Right? Yeah. Again, I want to stress this, not a recommendation for or against Apple. I'm using it as an illustrative purpose because they've been such a big buyer of their shares. Can't stress this enough. I think this is kind of one of those under the radar data points that doesn't get referenced enough. Nick, your thoughts and comments before I go on to the next one.
Yeah, the main comment I have for listeners is answering any question that might be popping in someone's head, which is, okay, why do they buy it back? Why buy the shares back?
Yeah, let's do that.
Companies, especially once they get to a cash profile where they're making money, they're profitable, they're making a bunch of money, they're making a bunch of free cash, you have options as to what you can do with that cash. And sometimes there's very clear answers of, hey, this is where we want to use our CapEx, our capital expenditures. We want to invest big in this area. Sometimes they want to sit in cash for a while. And sometimes they say, the best thing for the company right now is to go out and buy back our shares because we think it's a good deal for the company. We think it's a good deal for our investors. It's a good use of our cash.
Yes.
And so that's really what it gets down to, is it's making that decision of the company, and the board is saying, that's a good use of our cash.
Yeah. I mean, I think I also take it as a bullish sign, because if that board in the C-suite feels their stock is undervalued with where it's going to be, say 3 to 5 years down the road, as an example, and they're doing that to benefit shareholders.
And they
interesting.
They feel better about doing that than doing like a couple one-time like special cash dividends, or then just kind of holding the cash, or finding something else to invest in, a small acquisition, or another industry, opening up another kind of like department kind of thing.
Sure.
and I'm speaking broadly here, not just about Apple.
Yeah,
right?
I think it's great. I think it's good for investors to hear that, because I think the other aspect of it is returning cash to investors via dividends. And I think the reason that is not as popular for companies is the last thing they want to do is cut a dividend. So, you know, a stock buyback is a lot easier to pause. You know, you start doing dividend raises, it's kind of like you raise that, you don't want to cut it, or you know what I mean?
Yeah, you don't drop it.
You don't want to drop that.
When you drop your dividend, that's a very bad sign for the market. For big investors do not like that.
Do not like it. Yeah. So my second piece, and I think this will be very insightful, okay? My second piece is, will we have a recession or not? And if we did, what does that mean for the stock market, right? So listeners and viewers, to be very direct, is there still a possibility that we have a recession later this year or next year? Yes, that's a possibility.
Yeah, absolutely.
I know the market has rallied really hard off that low. We're not back to the all-time highs that we saw in February, but are we out of the woods yet from the recession concerns? No. So I want to throw this out there, because then it leads to the thought of, well, if we did, how bad could it get? How bad could it get for risk assets in the stock market? And what caught my eye was this piece from Callie Cox on May 6th. We've had Callie Cox on the podcast before. She does a great job in doing some really raw research and sharing that. And so this piece that was posted on her social media is titled, "Recession-Fueled Sell-Offs Have Been Destructive." And what she's highlighting is S&P sell-offs with and without a recession. And what she's illustrating here is, and this goes back to roughly 1950, are sell-offs of at least 10%. And when those sell-offs have occurred in hindsight, when we've had a recession, and when the sell-off happened in hindsight and we did not end up going into a recession. And Nick, what you're going to gather here really quickly when you look at this is that on average, since 1950, when we have a recession, the S&P 500 dropped on average 31%. Whereas in non-recessionary drops of at least 10% or more, the average was 16%. And so if you kind of think through, if the administration doesn't thread the needle appropriately, and we do go into a recession later this year, what that could mean for the markets is more downside. And so if we're 10% off the highs and the average is 31%, tongue in cheek, if someone asked me right now very directly, Matt, what do you think the pain could be if we go into a recession? I could argue another 20% based upon history. Now, if we don't go into a recession, in hindsight, this will be more of a V-shaped type recovery, and you could see the markets continue to recover as the year goes on. This then plays back into what I said at the beginning of the podcast. You got to be investing for the long term. Timing this market on a short-term basis, especially given the uncertainty right now, is not wise. Could you be tactical and maybe raise and lower stock exposure from time to time? I'm not against that. But making big moves, jumping in and out, is not something I would advocate. Before I go to the next topic, your comments, Nick.
I think I would just piggyback on the very last thing you said there. I almost would never advocate to be jumping 100% of your investments in and out of the market. Raise a little cash, and investors and institutional investors do that all the time. And that's more of a allocation decision, right? That's different than jumping in and out of the market.
So my next topic, and I'm going to play this into two things. My next topic is I saw this piece from Ryan Dietrich about S&P for performance after recovering 50% of bear market losses since 1950. I'm going to go over these stats, but I'm also, with Jenna's polite reminder yesterday, we're going to review some stats from a month ago that I think will be very enlightening. But let's start with the piece at hand. Ryan Dietrich had this piece. The date was May 4th, Nick. And it goes back to 1950, and it shows what the stock market, specifically in this case, the S&P 500 index, Nick, what it does after it recovers 50% of its bear market losses. A bear market, for newer listeners, is when the market sells off 20% from its high water mark. Okay. And so what happens is 1 month later on average, you'll see here it's up 0.7%. 3 months later on average, the market's up another 5.9. 6 months later, 10%. 12 months later, nice double-digit number of 18. Now, is this guaranteed? Absolutely not. But it's just the lens of history. And the success rate of being positive 6 months later is in, was it 68%? And 12 months later, in the data set, going back to 1950, about a baker's dozen, 100% of the time it's been up. Now, it's always going to be that one time, right? We could be negative 1 year from now.
Sure.
But it's neat to look at the lens of history. That's a good data point. Now, this provides a good segue for something Jenna politely reminded me of that we talked about a month ago. So this goes back to the podcast. I don't want to mess this up. It's been 1 month. Is that correct, Jenna? Yes. Episode 295 of the Independent Advisors podcast. We highlighted a piece of research from Ryan Dietrich, and this is what the piece was. It said S&P 500, 10% drops in 2 days, and how the market performed going forward. It was about a month ago. Okay, Nick? And the data set was 4/4/2025. The 2-day return for the S&P was down 10.5%. Through the lens of history, small data set, about roughly 5 or 6 data points. 1 month later, on average, the market was up about 8%. 3 months later was up on average about 6.5%. 6 months later, up 15, 30, and 12 months later, up about 32%. But the 1 month later check-in, you ready? Market's up about 10%, maybe a little bit more, and the average was 8. Lens of history, not saying it's always going to be this accurate.
Yeah.
But when we quote this stuff, it is the averages.
Yeah.
And sometimes it happens almost spot on.
Yeah, for listeners, this is a perfect example of why we
Look at this data.
Data. Yeah.
Right? That's why we look at this data.
Yeah.
So quite interesting that nailed it, and good catch there by Jenna. If we were able to reference it. Nick, what do you got this week for listeners and viewers?
Yeah, I have a couple here. I'm gonna kind of zoom through a couple of these in the interest of everyone's time. So I know you and I could probably go on and on about some of these topics. So
I could talk about this stuff for the entire day.
We'll try to keep it moving here.
One day, you know what we're going to do? We're going to do like a Joe Rogan, like 3 or 4 hour just extravaganza.
Yeah, just get the three of us in here and just
game time.
Have a good time. Yeah. So the first one is just a quick update on earnings. This is from Charlie Bilello. This research was released on the 6th of May. With 55% of companies reporting, the S&P 500 first quarter operating earnings are up 9% over the prior year.
Oh, I'm sorry. Was that up 9%?
Yeah.
Okay.
The 9th consecutive quarter of positive year-over-year growth.
9th consecutive quarter
of positive year-over-year growth. Yep. Okay. Trailing 12-month earnings are on pace to hit another high, up 10.5% over the past year. Profit margins expanded to 12.3%, their highest level since Q4 of 21. He does caveat by saying, while earnings overall were positive in Q1, the market seems divided on the basis of their anticipated tariff impact, which makes sense. He goes into details on specific stocks and things of that nature in his post, but in a nutshell, the market's looking at these earnings as we would expect, and they're saying, hey, are you impacted by tariffs? Less so than this company? Okay, well, they're buying the companies that are less so impacted.
Yep.
Right? That makes perfect sense. But
absolutely,
the main takeaway from this piece is that earnings are strong.
Another topic that's not being talked about enough.
Yeah.
And really, I mean, this is a strong data point, because when you have quality earnings, I mean, 9 consecutive quarters of positive year-over-year growth for the S&P 500, and you see this kind of short-term uncertainty, what it says to me is that a lot of these companies' balance sheets should be pretty good with that type of growth on average.
They're definitely in a better shape than maybe some people would think.
That's a good way of saying it, Nick.
Yeah, I think where you're getting some of, and I've even said, there's been a lot of like mixed earnings reactions and mixed earnings in general. And it's, when I say that in past podcasts, really it's more about the guidance outlooks are more mixed. And so that's kind of where you're getting some of that like gray area. It's like the underlying earnings generally are still very strong, especially when we zoom out and look at, hey, let's look at the whole market.
Sure.
Very strong. But when you start kind of getting into the weeds, that the guidance is what's spooking the markets a little bit because of the tariff situation. So, which is not surprising.
Yeah,
but,
and heck, if I were in the C-suite in North America and I had a chance to sandbag and have low expectations and get away with it, why wouldn't you?
Yeah, absolutely.
I mean, if you're an executive really sticking your neck out there with aggressive like guidance,
give yourself
that business better be really strong.
Yeah, right? Exactly. So my second piece here it's a really cool article from Bloomberg, and I encourage listeners to check it out. You should be able to read a couple free articles unless you've reached your limit. And it was a deep dive on exactly how the tariffs would actually impact consumer goods, and they took this ship that is called the OOCL Violet. And it's one of the first ships to see the impact of the 145% tariff on nearly half of Chinese cargo. And it basically goes through and it breaks down and uses estimates, of course, on what the new tariffs are actually going to look like for these goods and for the importers, and kind of explaining it. So there's a ton of infographics in the article, and we'll throw up one here for listeners that shows the estimated value of the Chinese goods. That this is just one individual ship. So there's $231 million of estimated goods, and the tariff on those Chinese goods, and the tariffs on those Chinese goods, subject to the 145 tariff, where the tariffs are $335 million. The Chinese goods not subject to the tariff, about $250 million, subject to about 75 million of tariffs. And then you can see the goods from other countries in this chart. And then what I did for listeners, we'll throw this chart up because I think it's interesting. And if listeners want to pause it and kind of read some of these comments that I pulled from the article, by all means. A bunch of their little infographics break down the different categories of goods: knitted apparel, industrial machinery, electrical equipment parts, cars,
what's
trucks,
on the ship.
And then it showed the estimated value of goods, and it showed the new estimated tariffs.
Interesting. And
so you can get a sense this is just one ship, but there's so many different goods on there, and you can really see the value of these tariffs. And it's a good piece to really understand.
So
what does this actually mean?
The original value of items on this ship was $564 million. And if I'm reading this correct, that's going to be subject to $417 million in tariffs.
Correct.
In taxes, import tax.
Correct.
Okay.
And so when you start going down and looking at this, if you're a consumer and you're thinking, oh, okay, well, like how much do we actually get from China? What do we get from China? This can give you a sense that a lot of different things. It impacts, so these tariffs impact so many consumer goods and so many companies. And you can see that from knitted apparel to industrial machinery to cars, trucks, furniture, plastic products, footwear, leather articles. I mean, the list goes on. So it's a cool article, I think. And again, this is hindsight kind of stuff, because these tariffs we know are likely to change very soon, with the first announcement again coming in 15 minutes from where we are now. Yeah. So I don't want listeners to get too hung up on this or worried about this. It's more just to give you some actual hard data.
Yeah, give a good example of what this is going to do.
What does this actually mean? Why did the market freak out so much?
Wow.
And this is why the market freaked out so much, is because what this does is, especially if you even think about like a U.S. business, and there are some U.S. businesses in here that that the article quotes. So the fish and seafood section, it's a small section, but $3 million value on that ship, subject to 3 million new tariffs.
Yeah.
And the president of one of these fisheries that's basically pulling these in from Buffalo, New York,
Okay.
said that it's a bunch of frozen cod, essentially,
Okay.
right? And he said, quote, "Our margin is slim. We have to pass that cost along to consumers."
Not surprised.
Right. So when you pass that cost along to consumers and the price doubles, as we've seen these prices, and it might not be double because it's got to go
Are you going to
through
have some
importers.
demand destruction on that?
Exactly. Demand destruction. Once you destruct demand, some companies can't even deal with the margins, like passing along that. And so what happens is you kind of really crush the demand in the economy. And that's where the recession talks come from.
Sure.
So I think this is a good chart.
Good illustration of that.
And a good
of what
illustration
could lead to it.
Right.
That's right.
Right.
The one thing that caught my eye is on this chart, listeners and viewers, if you're listening by traditional podcast, under the subcategory of toys and sports equipment, right? It has comments from the article.
Yeah.
$323,000 worth of basketballs bound for Cincinnati totaled $469,000 in new tariffs. How much b-ball's happening in Cincinnati that I'm unaware of?
Yeah. Yeah, it's pretty cool.
That's a lot of basketballs.
It's a cool article. I really do. I encourage listeners to check it out. It won't take you that long to read.
That's good, though. I think it's good to make it relational, right?
Yeah.
You hear about these tariffs and how it could affect goods. That's why we're not, in my opinion, out of the woods yet, because even if we have, let's say over the next 3-4 weeks, all these tariff deals end up happening, you're still going to have some disruptions to the supply chain. This stuff's going to lag 3, 4, 5, 6 months.
And the longer it goes on,
The more
worse
exponential ramifications that'll occur.
Exactly. And the article goes into that a little bit as well. So the last piece I have is a quick piece from Bloomberg again, but it's from Goldman Sachs, who basically says that bear rallies are the norm. Goldman Sachs Group
Bear market
strategists.
rallies, for our new listeners, are rallies within downdrafts for the market, like downturns.
Yep. Goldman Sachs strategist Peter Oppenheimer said the asymmetry for equity investing is poor. Sharp rallies within bear markets are the norm, not the exception. There's a chart here that we'll throw up that shows kind of where we are, and some of these, as you mentioned, alluded to earlier in the podcast, some of these big money shops, these big banks, these institutions still have cash on the sideline and are trying to figure out
What they're going to do here.
what are the chances of a recession. Do we put cash back to work,
Yep.
or are we going to have another leg lower? And they show you kind of looking at average corrections in this chart. And, if it's going to be an average correction with a bear market, kind of the typical trajectory that you would expect based on trading days, essentially.
Yeah.
So it's a cool chart. Just I wanted to throw the chart up for listeners, really as a way to think of and remind listeners that we could still break either way.
Yeah, I mean, what this says to me is the next 2 months are very important for the market.
Very important.
Because you get past 2 months, you look at the lens of history, you'll know if we're guiding towards a recession or not based upon this data in another 2 months, right?
Yeah.
So we're not out of the woods yet. And I'm not saying this directly towards Goldman, but just there's multiple big banks and investment firms that were negative in March and early April and still are. I'm not saying Goldman's in that group. That way we don't get nasty grams from them.
Yeah.
But I know there are several I've seen in the headlines, and it'd be interesting to see that if we don't go into a recession, how they handle that.
Yeah, that's sometimes I don't envy those guys' jobs, those top strategists at the bulge brackets who have to make these calls.
Sure.
And yeah, sometimes they get it right, but man, when they get it wrong,
They got kahunas the size of mangoes.
yeah, it's a very tough, being a strategist is tough.
Yeah.
So,
Well, next week's important for us. We got episode 300 of the Independent Advisors podcast on deck. We're going to do a special after hours podcast on Wednesday. We're going to record at 4 o'clock. I'm going to have some cocktails are going to be involved.
All right.
I'm sure I'll get on the soapbox for something. I'm sure I'll get poked one way or another.
We can get you on the soapbox. We can get you on the soapbox for the Knicks.
You easily can get me on the soapbox talking about the Knicks. But yeah, it's going to be fun next week, and Jenna will get that up in the system the following day on Thursday. So for our regular listeners, we'll be recording on May 14th at 4, and then we're going to release that sometime on May 15th. I know Jenna will. Before we break off here, Nick, final thoughts, comments on the economy, the market?
No, just hang in there. You know, I know it's been a wild ride. So
I don't think we're out of the woods yet.
Not out of the woods.
Volatility's still going to come around.
Yeah.
My only other words of wisdom is we're kind of on the tail end of earnings season. There's still some late reporters that I know, like in the tech space, some in the consumer space I'm thinking of. I won't name specific names that still have to report, but for the most part, a majority of S&P 500 companies have reported their Q1 earnings. So I think we're going to have the next focus will be the jobs report coming up here. Okay.
Yeah.
So we'll cut it there. Thank you for listening to episode 299 of the Independent Advisors Podcast. We'll be back with you next week for the pivotal episode 300. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.